Today I'm going to show you what you need to be measuring in your agency besides just cash so that your agency is in good financial health. So this is our client financial reporting package. This is a demo company. It's the I Love Lamp marketing agency. And we're going to take you over to the Cash Insights tab right now. And over here on the left, what we've got is our client survey, which is a series of questions that determines how much or how many months really of cash you need to have in reserve in your agency. It's going to be somewhere between 2 and 6 months. It's a very qualitative thing. What we do with the survey is we quantify that. So as you'll see from this agency in the top left, they need to have 3.63 months of cash in reserve. And if we are to take their average 3-month fixed expense number, that's about $184,000. We multiply the two together, what we get is $666,000. Now this big chart in the middle, that white line is the amount of cash that they need to have in reserve. You'll see that it fluctuates over time a little bit. That's because fixed expenses fluctuate over time as we're managing the business. But you'll see that the bars are above that line throughout the course of the year. That is fantastic. But is it really fantastic? I'll bet a lot of you agency owners out there are thinking, man, we're flush with cash. We've got all of this work that's sitting in deferred revenue, meaning that it's cash that we've received and we've got to do the work, and we've got bills that are hanging out there. Our cash balance is good, but is it really good? Not sure. So here's what you need to do. That number up there at the top, that $666,000, we need to compare that to our working capital. Where is our working capital here? It's down at the bottom. $740,000 in working capital. Now, what is working capital? Thankfully, we've got this nifty little box down here that helps us out and figures out exactly what it is. So working capital is current assets minus current liabilities. Chris, what is that? Current assets are things that can be converted into cash inside of a year. Current liabilities are things that you have to pay out inside of a year. So current assets is going to include cash. It's going to include receivables. Generally, those are going to be the big items for agencies. Current liabilities is going to be your accounts payable, vendors that you need to pay, deferred revenue that you might have. So that's that cash that you collected, but you still need to do the work, that sort of stuff. If you compare the two, so we've got plenty of working capital here. We've got $740,000 in working capital. We've got $666,000 in cash. If you compare those two, this agency is actually in really good shape. Where we get into problems is when that cash reserve is great, but the working capital is not so great, meaning that there's very little receivables, you've got a lot of payables sitting out there, things that you're going to have to pay in the future. That can be indicative that you're headed for a crunch. So those are the two things to pay attention to. Definitely pay attention to your cash reserve, definitely pay attention to your working capital, but make sure that you're paying attention to those two things together, not in isolation. That will help keep your agency as financially healthy as possible. Again, if you like the video, please like it, please share it, please subscribe to the video below, and I will see you in the next video.